For years, US tech stocks were the darlings of global investors, dominating headlines and portfolios alike. The likes of Apple, Amazon, and Google seemed unstoppable, their growth stories captivating the world and setting the pace for global markets. Meanwhile, UK small caps were dismissed as risky sideshows, often overlooked and underestimated by the mainstream financial press and big institutional investors. But in 2025, everything changed. The narrative flipped almost overnight, catching many by surprise. Suddenly, UK small companies began to outperform Wall Street's biggest names, delivering returns that few had predicted. Headlines like "British Bulldog Bites Back" and "Is the UK the new home of growth?" captured the shock and excitement rippling through the investment community. For the first time in over a decade, the FTSE Small Cap Index sprinted past the S&P 500, marking a dramatic shift in market leadership. My own portfolio, heavy on these previously overlooked firms, surged in value, rewarding years of patience and conviction. The market's obsession with US tech had blinded it to the value hiding in UK small caps, where innovation and resilience quietly thrived. This wasn't a minor blip. It was a fundamental shift in where investors saw real value, forcing a global rethink of what drives long-term returns. Big fund managers and analysts were left scrambling to explain the reversal, re-evaluating their strategies and exposure to UK equities. The UK, long written off as sluggish and outdated, was suddenly the global leader, setting the pace for others to follow. While the US market faltered, UK small caps, lean, innovative, and attractively priced, found their moment to shine, proving their worth on the world stage. For patient, contrarian investors, it was a long-awaited vindication, a reward for sticking to their convictions when others doubted. The lesson? Chasing trends is risky. True rewards come from finding quality assets when they're unloved and holding on through the noise. 2025 proved that value, patience, and discipline can still win, even in a world obsessed with the next big thing. The year began with chaos. Rising interest rates, stubborn inflation, and a series of geopolitical shocks sent global markets into a tailspin. Investors everywhere braced for the worst as uncertainty gripped the financial world. The UK was hit hardest of all, with the FTSE 250 plunging nearly 20% in just the first quarter alone. The speed and scale of the drop left even seasoned investors reeling. In the panic, investors fled to the safety of US Treasury bonds and mega-cap tech stocks, abandoning UK equities and leaving them for dead. The exodus was swift and brutal. The S&P 500 also fell, but its decline was far less dramatic, widening the performance gap between the US and UK markets even further. The consensus among analysts and the media was clear. The UK was a sinking ship, and few believed a turnaround was possible anytime soon. But as the dust settled and panic began to fade, a new and unexpected trend quietly emerged beneath the surface. While the US market continued to struggle and recover only slowly, UK small caps staged a remarkable comeback, bouncing back with surprising strength and resilience. Investors started to realize that many British firms were trading at absurdly low valuations, offering rare bargains not seen in years. Profitable, well-managed businesses, many with strong balance sheets and global reach, were suddenly on sale at a fraction of their true worth. The rebound was led not by the big multinationals, but by nimble, innovative small caps that adapted quickly to the new environment and seized fresh opportunities. By October, the FTSE Small Cap Index and my own portfolio were up over 18% for the year, a stunning reversal from the gloom just months earlier. The S&P 500, meanwhile, barely broke even, leaving many US investors disappointed and searching for answers. The crash had effectively reset the market, clearing out the excess and allowing undervalued UK companies to finally shine in the spotlight. It was a classic case of panic selling, followed by a slow, steady return to reason as confidence gradually returned to the market. Sometimes the best opportunities arise from the market's biggest overreactions. For those who kept their nerve, the rebound proved that patience and perspective can turn chaos into profit. One unexpected driver of the UK's rebound? A weak pound. While a falling currency usually signals trouble, it gave UK exporters a huge boost. Companies earning in dollars saw profits surge when converted back to sterling. The weak pound made British bids more competitive, especially as global supply chains shifted. Government incentives for domestic manufacturing amplified the effect. The result, a virtuous circle, with UK small caps thriving on export demand and policy support. Sometimes, what looks like a weakness can become your greatest strength. My approach wasn't about betting on a single turnaround, it was about discipline. I screened hundreds of UK small caps for consistent profitability, strong balance sheets, and high returns on capital. Only companies with solid financials made the cut. Then, I dug into their business models. What gives them an edge? Do they have a moat? Management mattered too. Experienced leaders with skin in the game. Finally, valuation. I only bought when shares traded well below intrinsic value. This margin of safety protected me from mistakes and market swings. The result? A resilient portfolio built to weather storms and capture upside. In small caps, it's not about chasing hype. It's about finding quality at a bargain. That's how you win in the long run. My investment philosophy is built on three essential pillars: quality, value, and momentum. These principles guide every decision I make in the market, helping me navigate both opportunities and risks with confidence. Quality means seeking out companies with consistently strong profits, healthy cash flow, and manageable low debt. These are the businesses that can weather economic storms and emerge even stronger, showing resilience when others falter. I focus on firms with high returns on capital employed. This is a key indicator of a business that not only survives, but thrives, compounding wealth for shareholders year after year. Value is about buying these high-quality companies when they're trading at attractive prices, often identified by low price-to-earnings ratios or other undervaluation signals. For example, in early 2025, many UK small-cap stocks were available at bargain prices, providing investors with a crucial margin of safety and the potential for significant upside. Momentum is the final check in my process. If a quality, undervalued stock is starting to rise in price, it's a strong signal that the broader market is beginning to recognize its potential. I don't buy just because a stock is moving up, but when momentum confirms my analysis, it's a powerful sign that I'm on the right track. By combining these three factors, quality, value, and momentum, I create a robust, well-rounded investment strategy that stands the test of time and adapts to changing markets. This approach keeps me focused on the fundamentals of each business, not distracted by market fads or short-term hype. The very best opportunities arise when all three elements, quality, value, and momentum, come together in a single stock. That's when you get that rare combination of safety, upside potential, and strong market support, making for a compelling investment case. The process is straightforward, but its effectiveness comes from discipline and consistency. It's simple, but it works. And it's exactly how I've managed to build my best-performing portfolio to date, achieving results I'm truly proud of. In 2025, the biggest winners weren't in tech or finance. They were in old economy sectors. Mining and material stocks, long ignored, soared as demand for commodities like copper surged. UK small-cap miners, trading at rock-bottom valuations, saw profits and share prices double. Industrial engineering and manufacturing also rebounded, fueled by a weak pound and reshoring trends. Specialist firms supplying aerospace, defense, and medical industries thrived. Meanwhile, consumer and speculative tech stocks struggled as inflation squeezed budgets and risk appetite faded. The lesson? Markets rotate. Yesterday's laggards can become tomorrow's leaders. Diversification and a value-based approach paid off. The real money was made by owning quality in the most overlooked places. Let's get specific. Real companies, real results. Volex, a maker of power cords and cables, was ignored for years. But with strong financials, smart acquisitions, and a boost from reshoring, its shares soared over 70%. It's proof that boring essential businesses can deliver spectacular returns when bought at the right price. Another winner, Renew Holdings, which maintains the UK's infrastructure. With steady, recurring revenue and a surge in government spending, Renew's shares climbed as its order book filled. These weren't speculative bets. They were investments in the backbone of the economy. The key? Focus on fundamentals, not hype. Growth often hides in the most predictable places. If you look past the headlines, you'll find the real winners. That's where the magic happens. Despite the stellar year, small cap investing is not for the faint-hearted. Volatility is the norm. Share prices can swing wildly on little news. If you panic at red numbers, this isn't your game. Liquidity is another risk. It's harder to buy or sell large positions without moving the price. That's why I build positions slowly and avoid thinly traded stocks. The biggest trap? Value traps. Stocks that look cheap but are cheap for a reason. A low price isn't enough. The business must be fundamentally sound. Diligent research and humility are essential. Sometimes you'll get it wrong, admit mistakes, and move on. Patience and discipline are your best defenses. The rewards are real, but so are the risks. Know what you're getting into before you dive in. Looking to 2026, there's reason for optimism. UK stocks remain much cheaper than US peers, leaving room for further gains. A weak pound and global supply chain shifts continue to benefit UK exporters and manufacturers. Political stability has returned, giving investors confidence. Institutional money is starting to flow back into UK equities, fueling momentum. But risks remain. Geopolitics, inflation, and interest rates could still disrupt markets. The key is discipline. Buy quality at reasonable prices, diversify, and stick to your process. The success of 2025 wasn't luck. It was patience and strategy paying off. That's the approach I'll keep, whatever 2026 brings. In investing, consistency beats chasing the latest trend every time.